So let's talk interest rates. Some people don't know what the actual nominal difference is between getting a loan at a 3.5% interest rate compared to 6.5% at today's or even 10. First, let's look at the historical variations of interest rates dating back to, let's say, 1975. And then we're going to compare what the purchase price and monthly payment would be for the same property across a multitude of different interest rates. So if we look back in history, you can see that our rates at 6.5 today aren't even that high in the grand scheme of things. Now you can take into account our purchasing power, and inflation fluctuates differently in history, but today our 6.5% interest rate doesn't really, scare people of the 80s or 90s. So what we're going to do is I want to show people the difference in purchasing power if you got an interest rate at 3.5%, 5, 6.5 at today's rate, 8% like 2000s, or even 10%. All right, so for each scenario, we're going to assume that we have $5,000 in property taxes and that we're spending around $1,000 in home insurance. So now let's look at a $1 million property. At a 3.5% interest rate, you're spending around $4,000 a month and spending about $1.5 million total with the mortgage over the life of the loan. So now let's look at 5%. At 5% interest rate, you're spending around $4,800 a month and spending around $1.73 million for your $1 million house. Now looking at the rates today around 6.5 to 6.8%, you can see that you're paying around $5,500 in monthly costs and you're paying double the price of the property. You're spending $2 million on a $1 million property over the life of a 30-year loan. So now at an 8% rate, that same $1 million house is now going to cost you $2.3 million over a 30-year lifespan and cost you $6,400, give or take, a month. Now to really give you nightmares, if you were to get an interest rate at 10% over a 30-year loan, you'd be spending $2.7 million on a $1 million property and have monthly payments of around $7,500 a month. So I hope this video gives you a little perspective on the difference of your purchasing power at different interest rates. And when you look at interest rates over a half decade, you could see that a 6.5% rate isn't even that astronomical. There's a lot of people waiting on the sidelines right now, waiting to see what the market does. If interest rates fall a little bit, maybe under 6%, there's a lot of purchasing power on the sidelines. It's also super important to understand adjustable rate mortgages and know that a lot of people pulled out 2.5%, 3.5% mortgages in 2020 that were 5-year terms and were adjustable rate. So they're coming up on their 5 years and they're going to have to get this new mortgage rate at 6.5%, maybe even 7.5% or 8%. Now, a lot of these, if they're commercial loans, they're going to default on these loans if you're not pulling in that income to support a 7.5%, 8% mortgage, which is almost triple what you were paying before. All important information that you should all consider. And if you have any questions or concerns, give me a call.